Karen Baldishwieler. My colleagues call me K14, so they don't have to pronounce my crazy 14 letters Swiss last name. I'm one of the 4 co-founders of Zenagos. We call ourselves the Zenagos experts, and all 4 of us are here today. We have extensive business experience. So Monica is the master of the complex deal involving combinations of public and private entities, nonprofits, governments. As one example, she negotiated a ground lease for a $13 million public-private aviation project in North Carolina. Stacy has advised branded companies, including Fidelity and Land's End, but she spent the last 2 decades helping a wide variety of small businesses to improve their digital marketing and their technology. Mavis has sold and delivered multi-million-dollar e-commerce technology deals to global companies like Walmart and Nestle. And I was a subject matter expert for EdTech deals serving big colleges like University of Kansas, the College of William and Mary. So we each have a lot of experience in big companies. But what we're most proud of is that we've started 17 small businesses between us. So we've each been a solo entrepreneur at least once in our lives, and we know how hard it is to get one customer to buy your offering. So now at Zenagos, we help small business owners at a very affordable cost because we want others to have the help that we wish we'd had back then. So our clients typically fall into one of 3 categories. First, we help the small business owner who needs to try new ideas to increase revenue. Second, we work with business owners who need to make their revenue steady and predictable so they can build a self-sustaining company. And finally, we advise business owners who want to launch a new offering and they want to get it right the first time. What they all have in common is that the entrepreneur spends a lot of time wondering about their decisions. So we help remove all of that second guessing. We help our clients as a sounding board. And what's different about us is that we're available Monday through Friday, 10 a.m. to 10 p.m. Eastern time. So our clients don't need to make an appointment. They just ask their questions. We respond in as close to real time as we can. These are some of the kinds of questions that our clients ask that we help answer. No more time wasted wondering what they should do. So that's a little bit about us. We're thrilled to have an opportunity to share with and learn from you today. So first, a couple of housekeeping items. So please do ask questions. We may have some people in the room here. It's Monday night, and so it may take them a little time to catch up with us, but you may hear them come in at some point during the presentation. If I'm in the flow of explaining something, I may ask you to hold on to the question for a minute or 2, but generally we want to answer the questions right when they come up. So if you're attending online, Monica's going to be watching out for your questions and passing them to Stacy, who's here in the room, and she'll ask them of me at the appropriate times. So I'll give you some quiz questions to answer in the chat too, so please do use the chat. And then at the end of the presentation, we're going to have some Q&A time. So if you have a question you'd like us to answer, do put it in the Q&A. There's actually a chat and a Q&A. The Q&A is better for questions because the chat moves really quickly. So your question could get buried in the chat. So if you want us to ask at the end, put it in the Q&A. Answer at the end. If you want to connect with one or more of us on LinkedIn after the session, please make sure to say that you were at the CDD workshop. That way we will accept your invitation. And Stacy's going to put our LinkedIn links in the chat in a moment. If you're in the room, they're in your handout.
Karen, you might need to reshare your screen.
The slides aren't showing right now. Thank you for telling me that. Let me see if we can get that reshared. Okay. Are you seeing a slide that says Zoom housekeeping items?
Yes.
Good. We're in there. All right, the objectives today, by the end of this session, you're going to be able to explain why business financials matter. You're going to be able to list what matters to bankers and other financial professionals. You're going to be able to complete a simple monthly financial checkup. And then you're going to be able to read the 3 key business financial statements. Once we know how to read them, we're going to play a little game called Finance Detective, which will be kind of fun. And you don't need to worry about taking a lot of notes or screenshots because at the end of the presentation, we're going to give you a QR code and a link so that you can download the summary slides. So you don't have to worry about what's on the slides in terms of your note taking. Before we get started, let's just get a sense for what kind of businesses you own and operate. So if you're on Zoom, put your answer in the chat and just tell us a little bit about what kind of business do you operate? All right, I see ATD, Alan, Ismani, Julie, tell us a little bit about your business. What kind of business is it? I used to run a tutoring business and an educational consulting business. That's my first businesses when I was 25 years old. Monica still runs an aviation consulting business and has run a number of health and wellness businesses over the years. We have a solopreneur consulting for nonprofits and philanthropy. Thank you, Julie, for being brave. Stacy has run a number of jewelry businesses over the years. And Mavis has run a consulting business. Okay. Ismai's thinking about starting a business. Okay, great. Thanks for telling us a little bit about you, and keep engaging in that chat. It's great stuff. All right. Why do we even care about business financials? Why do we bother with all of this chit chat? So can you think of a situation where you would need to provide your financials to someone? Most people think about taxes, because small business owners typically need to submit estimated taxes every quarter. And in addition, you need to have your books in good order if you ever want money from someone else for your business. So if you apply for a loan, which needs to be paid back with interest.
So the panelists can't see, or sorry, the attendees can't see your screen. In the lower right-hand corner of each of your screens where it says enter webinar, can you click that?
In the lower right-hand part of my screen.
Next to the end or exit button.
Show webinar?
Yep.
Let's try that. All right. How's that?
It still shows that you're all backstage.
We're having a little technical issue. We're going to get it fixed up here.
Yeah, mine says backstage. Karen's backstage.
There you go. Now we can see your face.
But
You're also still backstage. So Karen, if you go down.
right there?
Yep.
Okay.
And then go to webinar.
Let's do it.
There you go.
All right.
And then you may still need to reshare your screen.
Okay. Well, this is a very complicated version of Zoom, but we've got it set now. All right. Tell me if you see an angel. Do you see a woman with a halo? If you do, we're in the right place.
Yes. Julie said yes.
Okay, good. All right. So if you ever want to take money from an investor, even if you're only crowdfunding, you're going to need to submit your financials. And if you ever want to sell your business, you will be amazed by all of the financial information that you have to share. So financials or books, that's another word, we call them the books, are how we communicate about the strength of a business. So when I studied accounting for the first time, I thought, this is crazy. Why do we bother with all this strange language and all these weird rules? And the answer is that we have to have trust in order to do business. So when one person wants to buy another person's business, there has to be some kind of fair and trustworthy way to communicate about that business. So without accounting rules, nobody would ever buy a business or buy stock in any company because they wouldn't be able to trust the value. So your financials are very important. They tell the story of why somebody should trust you and your business. Okay, pop quiz. What do you think is the #1 problem for small business owners who want to get a loan? Is it bad credit? No, but that doesn't help. Is it lack of collateral? No, but having collateral can help. It is having messy or missing financials. So you can actually run a business for a long time without paying any attention to your financials, and many small business owners do. It's also really common in some fields to operate in cash, hiding some of your income from the IRS so that you can pay lower taxes. This is technically against the law, but like speeding, it's a law that a lot of people go over the line with. But the problem comes when you want or need money from somebody else. So for example, one of our clients, we'll call her Marie, found a perfect breakfast cafe to buy. It was owned by an older couple, and the wife suddenly became very ill. So the husband had to sell the restaurant really quickly. It was an awesome deal. It was perfect for Marie. But when she and her boyfriend applied for the loan to buy the restaurant together, they had some problems. So the couple that had owned the restaurant had been taking in a lot of cash and not reporting about 3/4 of it. So on paper, it didn't look like the restaurant made very much money. So Marie had a very hard time convincing the bank that when she took over the restaurant, it was suddenly going to make more than twice as much money. So they were like, you're not going to make enough money to afford your loan payments. Second, she only had 90 days to get the financing in place to buy the restaurant. And the bank needed several weeks to complete their underwriting process. So she really only ended up with a couple weeks to get her own financials in order. And so she just couldn't do it. In the end, the deal wasn't possible. It can take a little while to get your financials in order. So when the big deal comes along, it's almost always too late. So you don't want to be wishing that you cleaned up your financials 6 months ago. So that brings us to best practice number 1. Don't wait until you need the money. Get your books in order now, and we'll talk about how to do that. Choose a bank and build a relationship with your banker. It's never too early to start making friends, and consider getting a small loan to build a repayment history. Little loans are called microloans. You can just get a micro loan and then repay it and kind of show the bank I'm trustworthy and I can repay loans. And learn how to make your revenue streams more predictable. This is where getting a business coach or advisor is a really good idea. And then if you ever want to sell your business, you want to talk to a business broker at least 5 years before you want to sell your business. So if you're planning on retiring in a few years, go meet with a business broker now, because it's important to learn now if there's something that you should be working to improve so that you can get the best price for your business later. So perhaps you're thinking, I'm doing fine right now. I don't need a loan or anything. But one of the truisms about money and business is it's always easier to get money when you don't need it. So one of our clients had a fantastic year in 2024. And I told him, go to your business broker and business banker and get a line of credit. And he said, why? I don't need any credit and I don't like debt. And I said, because you can get a line of credit right now, and you never know if that's going to be true later. Don't use a line of credit, just build that relationship with your bank now while you can. And so it's always easier to get money when you don't need it. All right, let's talk about how. How do you set up your financials? So the first step is know your audience, know your stakeholders, know how money people think. Okay, pop quiz. What's the biggest mistake that small business owners make with money people? What do you think? All right, I can see everybody can see the presentation right now, so that's good news. So the biggest mistake that people make is saying the wrong thing to the money person. And they just don't know how the money person thinks. And so they say something that they think the financier will like, but it's actually the wrong thing. I'll give you an example. A business person would think that a banker would want to hear confidence and optimism about the business. So they say things like, we have no competitors. This is a no-brainer for a business. But bankers like to hear people that are reasonable. They like to hear people who know what the risks are and then say what they're going to do about the risks. So if you go in saying, I don't have any competition, that's actually a pretty big red flag. But you wouldn't know that. The only way to know how to talk to your financial people is to know your audience, get to know your stakeholders, know how money people think. So a stakeholder is a fancy word for someone who has a financial stake in how the conversation goes. So here's a list of typical financial stakeholders for small business. We're going to go through each of them just for a couple of seconds and spend a few minutes on how they think. So government institutions like the IRS want proof that backs up their paperwork. So they'll see it as a good sign if you can produce neat records that show that you keep up with your bookkeeping every month. So that's what the IRS wants. Now, your accountant is an important player in making sure that your books follow the rules. So accountants are about rules. In business, we call accounting rules the generally accepted accounting principles, or GAAP. I just like saying GAAP because I think it sounds really funny. An investor is a person who gives you money in exchange for shares in your company, which is usually called equity. If they take more than half your company, we call them a controlling investor, and they control the company. If you still own more than half your company after the investment, then the investor is called a financial investor, and you control the company. So investors want a growing market. So like, for example, right now, baby boomers are one of the biggest groups in the US, and they're all retiring. So any product that targets retiring age baby boomers is in a growing market. They want a scalable business model. So they want a business that can grow a lot. It doesn't depend on one person or some rare kind of set of skills to grow. Investors are betting on you as the leader of your business. So they really care about your credentials and your track record. Do you have credentials in the field? If you're going to be a plumber, do you know anything about plumbing? And then finally, they want an exit strategy. So people often don't know this about a business, but the person who invests in your business can't get their money back out unless something happens. It's called a transaction. So like you sell the business or you go public or you do something so the investors can get their money back out. So that's why an exit strategy matters, because they want to be able to get their money back out. So that's investors. Bankers are sort of like investors. They both give you money so that you can grow your business, but they think really differently. So an investor takes part of your company in exchange for their money. A banker doesn't get any part of your company. But with a banker, as long as you stay on, you pay your interest on time and you stay within your rules, they're called covenants, then you can keep all of your company's equity. You don't have to give any up to the bank. Investors are used to taking risks. Bankers do not like risks. They're very cautious. So the way to remember that is that bankers aren't using their own money. They're using their depositors' money. And so they have to be very careful with it, because if the depositors want the money back, they have to give it back. So bankers want to see that you have a history of repaying your loans. They want to see that the people leading your company have experience in the field, and they will ask a lot of questions about the story, about what you're going to do with the money, since that determines if you're going to be able to pay them back. Grantors are interesting. Unlike an investor or a banker, a grantor gives money without any financial strings attached. You can use the money, keep your equity, as long as you use the money for the agreed upon purposes. So grants are usually designed to go to nonprofits, but some can go to for-profits. For example, city and state governments might offer grants to local companies to help build up their local economy. But grantors look for grantees that will support their mission. So you may need to provide proof that you'll use the fund to support the mission. Clean financials are very important to grantors, and they often require audited financials. And grants often go to trusted organizations that have a long track record of delivering on the desired mission. All right, we're almost there. Business brokers. They get a commission for helping an owner to successfully sell their business. You may not even know that they exist, but they go out and they find people who are interested in buying a business. Since their livelihood depends on the business being sold, they want an entrepreneur who's ready to sell and who already has clean financials. And they also want an owner who's determined to get maximum value and will do what it takes to increase the value of the business. So the brokers often specialize in a particular industry or type of business, because they have to find the buyers. And so it helps if they have a Rolodex of buyers in a particular field. So those are all of the stakeholders. You can have all these slides. So don't worry, they're there for your notes later when you run across one of these stakeholders and you want to think, what do they think about? A business buyer wants to get at the best possible price. So they're like anybody who buys anything big, like a person who's buying a house or anything that has a value that could increase. They want a clear path to growing the business. So when you sell the business, you want to be able to tell a good story about how to get that business to the next level. And they also need to trust that they're getting what they think they're getting. So they do a process called due diligence so that they can learn more about your financials and get proof that your business is what you say it is. Okay, so all of those together bring us to best practice number 2, know your audience. So for most financial audiences, these are the key tips. Make sure your records look neat and organized, because it sets a good impression. Update your financials at least once a month. We're going to talk about that. Have an accountant review your books at least once a year. So when you do your taxes, you really need to have an accountant look at them. I know it's expensive, but once a year, have an accountant look at those books. And then be able to explain your books yourself. So even if you have a bookkeeper or a CPA or someone who works with your books all the time, you need to be able to talk about it yourself too. So have them explain it to you if you don't understand it. And then finally, you need to be able to tell a clear story about how you're going to grow the business. Whatever you're trying to do with your business and whoever you're dealing with, gather as much information as you can about the other party before you talk. And that will help you to understand what they care about and how to present your story in the right way. All right, let's say that you're like most entrepreneurs and you're not doing any of this right now. That makes you normal. You're busy trying to make your business successful, and it's hard to find time to do your paperwork. But if you want to take your business to the next level, you do need to get your financials in order. So where do you start? As the proverb says, a journey of 1,000 miles begins with a single step. So pop quiz, if I only had one thing to do to clean up my books, what should I do? So the most important thing to do is start a new habit. And this is the habit I would like you to start. Make a habit of taking 1 hour a month to work on your financial books. Don't break that appointment with yourself for anything. When that hour comes, keep it as simple and painless as possible. Just write down how much income you brought in last month and who it came from. And then write down how much you spent and what you spent it on. This small habit of looking at your income and expenses once a month is going to make a really, really big difference. It will get you thinking about how you're spending your money and whether you could be making better choices. So for example, picture a restaurant cleaning company. So they clean restaurants at the end of the day. They have 5 clients and they charge each client $300 a month. So for income, you just write down how much you charged and received from each customer. So this company had 5 customers and they charged each one $300. So 5 times $300 is $1,500 in income that's this month. So that's the first part. Just write down your income and where it came from, how much from each client. That won't take you too long. Then write down how much you spent. So this company spent money on cleaning supplies, gas, insurance, cell phone, and some bank fees. And it adds up to $222 in expenses for this month. So you wrote down your income and you wrote down your expenses. And now you want to know your net income. So you take the income and you subtract the expenses. So I use a calculator. $1,500 minus $222 equals $1,278. So that's the net income for our restaurant cleaning company for the month. This is going to take you less than an hour a month to do. In the beginning, it might take a little bit of time because you haven't done it before, but once you get used to doing it, it's going to take you a very short amount of time. So that's how to start. So if you could do one thing, if I could get you to do one thing, make an appointment with yourself once a month for an hour and don't break it for anything. And after you've done it for a few months, it's only going to take you a few minutes to do it. And then we'll go deeper into those financials and we'll give you a couple other fun things to do. But for now, let's record best practice number 3. Make a monthly financial appointment with yourself. So the most important part is that you build a habit of committing time to your financials. In the beginning, just record your income and expenses for the previous month. Clients ask us a lot of questions about how to keep their books. So there are a lot of good options. I kept my books myself in a simple notebook for my first 2 companies. It's actually pretty fast if you do it on paper. There are lots of payment apps like Zelle, Venmo, PayPal, Square. They may be able to help you keep track of your income. Accounting software can really help when things start to get complicated. Some accounting software can be free, but you usually need to pay for it eventually. The cost for accounting software ranges from just under $20 to over $100 a month, depending on what you need. And there's a learning curve. So when you first start using it, the software is going to take you a little bit more time than when you're just doing it yourself on paper. So if you decide to use an accounting software, try it out a little bit at first, and pick the programs that's simplest for you. So one example, you want something where you can just scan a receipt with your phone and it'll just put it in. You don't want to have to enter each little line on the receipt line by line. If you do a lot of receipts, that'll drive you crazy. If you can afford to pay an accounting firm to help set up the software for you, that's a good investment. But if you set it up by yourself, you're going to make some mistakes, and that's okay. Sooner or later, a bookkeeper and accountant is going to tell you what to fix and where to fix it, and that's fine. You'll learn just by entering information into the software and printing the reports. So it's worth your time to learn an accounting software. If you can afford a bookkeeper, that's a terrific solution for making sure that your books are in order. Most of our clients who have bookkeepers, they'll pay between $300 and $500 a month, and it can cost a lot more for a bigger company. And you do have to do your research before you hire a bookkeeper. Anyone can claim to be a bookkeeper. So state regulators regulate accountants and CPAs. So accountants and CPAs are held to a very, very high standard, which is why they're so expensive. But bookkeepers are completely unregulated. Anybody can claim to be one, which is why they're a lot cheaper. So the best way to choose a bookkeeper is to get a referral from someone you know and like who runs a business that you respect and say, who do you use for your bookkeeper? And after the bookkeeper's done your books for a couple of months, take those reports to your accountant and make sure everything meets your accountant's standards. It's always important to check their work and make sure that it's good before you go for too long. All right, when you've mastered the first 3, so you're recording your income, you're recording your expenses, you're subtracting, getting your net income, it's going pretty quickly. Then you can add on invoices if you do those for your business. Just do it during your appointment. If you don't send them out, you don't get paid, so make it a monthly habit. When you're finding that you don't need the whole hour to do the first 4 things, then you are ready to add some more advanced steps like number 4, number 5, and number 6. You can reconcile your books with your bank account. This is actually pretty challenging the first few times you do it because of the timing, because it'll be in your QuickBooks at one time and in your bank account at another time. You have to kind of figure out what happened. But that's a really good thing to do in your appointment with yourself. And then finally start recording your marketing and sales results. Write down how many new leads you got and how many new customers you got. We work with our clients on these things all the time because they make a really big difference in your success. What you inspect, you will respect. And so it's always important to make that appointment with yourself and check your financials. If you make a habit of this, you'll eventually get pretty good at predicting the future and do the most advanced thing, which is to make a forecast for the next 12 months so that you know what's going to happen in the whole next year of your business. All right, so that was a great overview. And now we're going to dig in a little deeper and have some fun. I told you that I did the financials for my first 2 companies myself. It was a tutoring business and an educational consulting business. At the time, I didn't know anything about business or finance. I'd taken a little bit of math in school, but I didn't know anything about business. Looking back, I would have found it really helpful to know some business vocabulary. So we're going to do a little financial fundamentals really quickly, and I promise to make it fun. Let's imagine that little sister Sophie and big sister Michaela want to go to the toy store. They each want a toy that costs about $30. So they decide they're going to start a business. They are going to run a lemonade stand. The lemonade stand's a great model for talking about financial fundamentals because it's a business we can all understand. So how much money can our little entrepreneurs make? The sign in the picture says 10 cents for a cup of lemonade, but I need some numbers that were a little easier to calculate. So Sophie and Michaela are going to charge $1.50 a cup. I know that's some pretty expensive lemonade right there. That's some Cambridge organic hand squeezed lemonade in recycled cups. So how many cups can they sell in a day? Michaela discovered that if she pays Sophie $5 to go to the street corner and twirl a lemonade stand sign, then they can sell 100 cups a day. I know 100 is a lot of cups, but it's easy to calculate. So 100 cups a day at $1.50 a cup is $150 in income per day. So for our purposes, we're going to call that $150 revenue. For most small businesses, income and revenue are pretty much the same thing. But if you start talking to an accountant about revenue, the conversation can get very complicated. But for our purposes today, we're going to use revenue and income to mean the same thing, the revenue that the money that you get from selling your product or service. And you just understand that there's some more complicated ideas about revenue that might be important at some point later on. The accounting custom in the US is to put income or revenue at the top of the page. So we're going to start our lemonade stand financials by putting $150 of income at the top, like this. Now we're ready to talk about costs. So we separate the costs into 2 types. The first is called direct costs. They're also called cost of goods sold, or COGS. In general, if your business is a service, the term direct cost is more common. If your business sells a product, then it's more common to use cost of goods sold or COGS, but you might see either one. Direct costs are expenses that can be directly linked to your product or service. It's usually materials and labor that went right into making your offering. An easy way to think about that is that direct costs are costs that increase every time you sell one more. So if you're selling a chair, every time you sell a chair, you need legs, a seat, and a back. Those are all direct costs. If you sell one more chair, you need one more seat. One more chair, one more seat. If you sell one more chair, you need 4 more legs. One more chair, 4 more legs. Those are direct costs, the costs of the materials and the labor that go into making the actual thing that you're selling. All right, so pop quiz. What are the direct costs or COGS that are common for your business? So if you're on Zoom, put your answer in the chat. And if you haven't started your business, talk about what you think the direct costs are going to be in your business. Okay, client meetings. Maybe you have to buy some refreshments for the client meetings or pay for some printing for the client meetings. The travel to and the meals at are definitely direct costs. Good. Good, good, good. In my tutoring business, we didn't have very much in terms of direct costs. How about in your jewelry business, Stacy? What kind of direct costs did you have?
So we had the actual materials that I used in order to make the jewelry, so jewelry parts. And then when I went to shows, there were, things, so paying for fees and things.
Right, anything that goes into making the thing that you're selling or delivering the thing that you're selling. Okay, good, 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 good. So, the other type of costs are fixed costs, which are also called overhead. You probably heard the word overhead a lot. These are the costs that you have to pay either way, no matter how much you sell. So rent is a really good example of a fixed cost. You have to pay your rent, whether or not you sell anything. Other common fixed costs are payroll, if you have full-time employees, or marketing, and then everything else, which we call operating or general and administrative, or G&A, sometimes also called sales general and administrative, or SG&A. That includes everything else. So the monthly cost for your website, the cost for Zoom, your email account, like Google Workspace, your cell phone, other utilities, insurance, they all go under operating or general and administrative expenses. So those are the key parts of your financials. Revenue minus direct costs minus fixed costs equals net income. Net income is also called profit. That may be a word that you've used a lot. Okay, pop quiz. What are the fixed costs in your business? Fixed costs. And if you haven't started it, what do you think they might be? So Julie, have you got any fixed costs in that business? Monica, you got any fixed costs in your business? There you go, the cost of your home office, exactly. Monica, any fixed cost in your business?
Yes, actually, I do. I have some marketing that requires fixed costs.
Great. Anything for your website? Anything like that?
Exactly. Yeah. Website, events, that kind of thing also goes into it.
Perfect. Okay, so the list on the left is all of the costs for the lemonade stand. So which of these costs are direct costs and which of them are fixed costs? So if you're in the chat, you can type direct or fixed. So we spent $26 on disposable cups, direct or fixed? We're thinking about those cups. Direct cost or fixed cost? Direct, exactly. $20 on lemons. I'm going to call that direct. $10 on decorations. Little flags on the stand. Direct or fixed? Decorations. What do you think? Those are fixed. We paid $5 to Sophie to go twirl a sign, direct or fixed? Those are fixed. $4 on sugar, direct or fixed? That went right into the lemonade, so we're going to call that direct. We spent $3 on markers to make the sign, to twirl the sign. We're going to call that fixed. And we paid $2 to Mom to rent the lemonade stand. We're going to call that fixed. We used tap water, so that was free. Awesome. So now we have a new accounting skill. We can separate our costs into direct costs and fixed costs. If I add up all these direct costs, I'm going to get a total of $50. If I add up all these fixed costs, I'm going to get a total of $20. So it costs Michaela and Sophie $70 to run their lemonade stand for a day. So now I'm ready to finish my financial statement. Remember, I had the income and revenue at the top, 100 cups at $1.50 a cup for a total of $150. Now I subtract my direct costs, also called cost of goods sold or COGS, a total of $50 for cups, lemons, sugar, and water, the things that went right into what I was selling. So what do I have left after my direct costs? I have $150 minus the $50 in direct costs, with that leaves $100. So I have $100 left, and we call that number gross margin. Gross margin is what's left of your income after accounting for all your direct costs. It's what you have left to cover all of your overhead. So this can be a little confusing because sometimes people use the word gross to refer to their income. So let's say something like, I grossed $10,000 last month. So one of the things you can learn about accounting is that there are a whole lot of words for the same thing, which is kind of annoying. But if you keep adding words to your vocabulary, you'll be able to talk business to anyone. So gross margin is what's left after your direct cost or your COGS. Financial people like to put a percentage next to the gross margin, so you'll know what percent of your income you have left after delivering your product. So 100 is 67% of 150. So we have 67% of our income or revenue left after the direct costs. And the other way of saying that is the gross margin percent is 67%. Okay, so that was fun. Now last, we're going to subtract our fixed cost or overhead. So let's make a list. We paid Sophie $5 to go to the corner and twist a sign. So that's payroll, $5. We're going to pay mom $2 to rent the stand. So that's rent, $2. We paid $10 for some decorations, little flags on the stand. So that's marketing, $10. And we bought some markers to make the sign. So that's operating expense, $3. We add that all up and we get $20 in total fixed costs. So what is my net income? I have 100 in gross margin, and now I'm going to subtract 20 in costs. So I have $80 left. Sophie Michaela's net income or profit is $80. A lot of people call this the bottom line because it's the bottom line of the financial statement. So Michaela and Sophie have $80 and they are rich, rich, rich. And now they're going to be able to go and buy their two $30 toys and maybe even a little bit of candy. They met their goal. So just like net margin, like gross margin percent, we also put a percentage by the bottom line. So we call that net margin percent. So 80 divided by 150 in revenue is 53%. So we say our net margin percent is 53%. Okay, that's some financial lingo. In big companies, this line can be called EBIT, which stands for earnings before interest and taxes. And just like GAAP, I think the word EBIT is funny. It's EBIT. When I went to business school, all the fancy people use the word EBITDA, which is earnings before interest, taxes, depreciation, and amortization. EBIT. This is a financial statement for the Walt Disney Company. You can see it's pretty complicated. If you want to see how much money they made from normal operations, that's what you and I think of as net income or profit, then look for EBIT. There could be a bunch of lines below that because they're doing a bunch of financial adjustments, but EBIT is the money that they made from regular business operations. So now you can look at any financial statement and just look for EBIT, which is their regular business operations, how much they made from operations. All right, we're going to give a brief thank you to Michaela and Sophie for providing a fun example. And now we're ready for a quiz. So go ahead and put your answer in the chat. Pop quiz. What goes at the top of the financials? Right on. Number 3, income or revenue. We always start with how much we collected in the time period. Okay, next one. What are the direct costs or cost of goods sold? Takes a while to read those options, but yes, it is number 3. What are the fixed costs or overhead? Good job. It's number 1, all of your other costs after the direct costs. What does EBIT mean? EBIT. Earnings before interest and taxes, that's number 3. Okay, this brings us to best practice number 4, learn some business vocabulary. So today we've already learned at least a dozen important words for business finances, and you have them listed right here. They're going to be in your PDF takeaway. And we're going to learn a few more in the next section. Hopefully you're having some fun. All right, I bet you just woke up this morning hoping that somebody was going to start a conversation about financial statements. I know this isn't the most exciting topic in the whole world, but don't fall asleep, because after this section, we're going to play Finance Detective. And if you learn about the 3 financial statements, you're going to do better in Finance Detective. Okay. The way that financial people communicate about a business is through 3 important documents called financial statements. First one's called the income statement. And we already did it. We did an income statement for the lemonade stand, and you know how it works. So ta-da, you know the first financial statement. The income statement is also called the profit and loss, or P&L. If you hear somebody talking about a P&L, they're talking about the income statement. It shows a company's income and expenses over a period of time. It's usually a month or a year. For the lemonade stand, we did 1 day. The kids sold 100 cups at $1.50 a cup. They made $150 in the day, so the income was $150. It cost them $50 to make a lemonade, so the direct costs were $50. We subtracted the 50 from the 150, so we know the gross margin was $100. The kids had 67% of their revenue left after direct costs. They spent $20 on fixed costs. And finally, we subtracted that 20 from the 100, so we know that their net income was $80 for the day. The kids had 53% of their revenue left after fixed costs. Their net income is $80. The kids made money. They made an $80 profit, and they went off and bought some toys. Operating income is also called EBIT. So that's the income statement. It's the most important one of the 3 statements. It's the one you're most likely to see and use. The second financial statement is called the balance sheet. It shows how much the company owes and has at a particular moment in time. Owes and has. Why do we need a balance sheet? Because a company can have really good income statement. They look like they're making a big profit every month. So you're like, things are going really well. But then it could turn out they have a huge debt to pay off. So they're actually not doing all that well. So the balance sheet shows what you have and what you owe. And you can't really tell what's going on with a business unless you know what they have and what they owe. The thing to remember about the balance sheet is this formula: assets equal liabilities plus equity. A equals L plus E. A balances with L plus E. Since balance sheets go top to bottom, the top balances with the bottom. Let's look at a few details. So assets are things that you own that have value. So some are really obvious, like cash in the bank. That's an asset. If you've already done work for somebody, but they haven't paid you yet, that's called accounts receivable, or AR, and that actually has value. If you have stocks or bonds that you bought for the company, that has value. If you have cars or trucks that you bought for the company, that has value. You might have heard the term PP&E, which stands for plant, property, and equipment, which means buildings, property, and equipment. Not a lot of small businesses own buildings, property, and equipment, but some do. There are other things you might not think of, like raw materials. So the lemons, the sugar, those have value even if you haven't made them into lemonade yet. And there's inventory. So let's say you made a bunch of chairs and they're sitting in your warehouse. You haven't sold them yet, but they still have value. And then there are things you might not think about, like patents or trademarks. And finally, accountants use something called goodwill, which is what they call things when they don't know what else they could call them. So if you see goodwill, that's because they don't know what else to call it. So pop quiz, what kind of assets could you have in your business? Monica, any assets in your business?
I actually have cash.
Cash is good. Cash is king. Stacy, what kind of assets did you have in your business?
So when I was doing what's called warm glass, I had equipment. So I have a number of kilns.
Right, equipment, absolutely. Okay. All right, so that gives us a sense of the kind of assets that we could have. Liabilities are things that you owe to other companies or people. So if you always pay for things right when you get them with cash or credit or Venmo, then you don't have any accounts payable. But if you have arrangements with your suppliers like net 30, where you have 30 days to pay them, then you may have some accounts payable. So that's called a liability. You owe it to them, but you haven't paid it yet. If you don't pay off your entire credit card every month, then that balance is also called a liability. If you've taken money down from a credit line, that's a liability until you pay it back. If you owe money on a loan, that's a liability. If you owe taxes next quarter that you haven't paid yet, that's a liability. Maybe you have a long-term lease. Basically, any kind of contract where you have obligations you haven't met is liability. So, okay, so pop quiz. Now, most people don't like to share what their liabilities are. So I'm just gonna ask, do you have any questions about what a liability is? This is kind of a list of, the kinds of liabilities. Do you have any questions about what those are? All right, if you do, let us know later. They come up. Equity. Now, equity is the hardest concept. Equity is collected value. It's the value that you've collected in your business over time. So if you've given out stock in your company to other people, then equity is the value of that stock. But most businesses don't give out stock. So equity is usually called retained earnings or owner's equity. So if you have an accounting program, and you see retained earnings or owner's equity, you're always like, what is that thing? That's your equity. So usually it collects over time. So it's your added up profit over time. So like in your first year, you made $100, and your second year, you made $100, then you left it in the business, then that $200 would be retained earnings, and it would be getting bigger every year. If your business is doing well, the retained earnings on your balance sheet will grow every year. If your business is doing badly, or if it's new, it might be a negative number. So it could actually be negative. Now, we're most used to talk about equity around home ownership. So let's say I wanted to buy a house worth $200,000. Probably not in Cambridge. That's an asset. I might go to a bank and get a mortgage loan for $160,000. So that would be a liability. The bank probably wants a down payment. So let's say I put down $40,000. That's my equity. So the house's value is $200,000. That's what it's worth. That's the asset. But that value is split between the bank and me. So right now, I only owe 40% of that value. My equity in the house is $40,000 because that was my down payment. That's my collected value. I've only collected 40% of the value so far. But the bank owns $160,000 of my value, but I'm going to pay them back over a long period of time to make that mine. And eventually the whole $200,000 is going to be mine, but I'm going to do it slowly over time. So assets equal liability plus equity. The $200,000 for the house is a combination of my $40,000 and the bank's $160,000, which I'm going to pay them back for over time. So we're used to thinking about equity that way. On a balance sheet, that would look like this. At the top, I have to put when the balance sheet was prepared because it shows my position at a particular moment. So I have to say what the moment was. So in this case, it shows my financial position right after I bought the house. So it says balance sheet after home purchase. Under assets, I used up all my cash, but I have the deed to my house, which is worth $200,000 because that's what the bank and I just paid for. So the top of the balance sheet, the assets, balances with the bottom of the balance sheet, the liabilities and the equity. So under liabilities, I put my new mortgage, I owe $160,000. Under equity, I put my down payment, I have $40,000. The bottom of the balance sheet shows what I owe and what I have, the value I've collected. So my assets balance with what I owe and what I have. All right, that's pretty complicated, but we're gonna make some balance sheets for the lemonade stand to help you understand the concept. So at the start of the day, my balance sheet is blank. Sophie and Michaela have no assets and no liabilities because they haven't started their business yet. Then the kids go and they talk to mom about doing a lemonade stand. They determine that they need to spend $50 at the grocery store for cups, lemon, and sugar. I know inflation, right? They decide that they need to spend $13 at the party store to get decorations and markers. So they need a total of $63, which mom gives to them in the form of an interest-free loan. Mom also agrees to lend them the lemonade stand structure for $2, but they're not going to have to pay that until the end of the day. So let's do the balance sheet after they talk to mom and get the loan. After mom gives them a $63 loan, the kids have $63 in cash. So that's an asset. They also owe mom $63, so that's a liability. And they also agreed to pay mom $2 later for renting the stand. So that's another liability. So their liabilities are $65. The assets are $63, but the liabilities are $65. Now we know it needs to balance. So what do? 63 on top, 65 on bottom. The difference is retained earnings, and it has to be negative. So in this case, the kids collected value is negative because they owe $2 more than they have in cash. They owe 65, they have negative equity. So having negative equity isn't great, but it often happens when a business is young. So that's how that balance sheet balances. The top is 63, the bottom is 65 and -2. At the end of the day, things look better on the balance sheet. So the kids spent $63 at the store, so that's all gone. But they got the 150 from the people who bought the lemonade. So now they have 150 in cash in the assets. 150 in the bank is good. As my friend Monica says, cash is king. They owe some things. So they still owe mom 63, so that's a liability. They owe Sophie $5 off the top for twirling the sign. That's a new liability because they paid Sophie $5. And they still owe mom $2 for running a lemonade stand. So now they owe a total of $70. They owe 70. What do they have? We know the assets have to balance with liabilities and the equity. So if we have 150 in assets and 70 in liabilities, then the equity has to be 80. That'd be 150 on top and 150 on the bottom. Why is it 80? Because the girls have 80. Remember that bottom half is owe and have, owe and have. They have $80 they've collected in their business so far. Whenever you make a profit, it adds to your equity section. Your retained earnings or your owner's equity grow. That's the same thing, retained earnings, owner's equity. All right, pop quiz. Let's make the last balance sheet for this lemonade stand. What is their balance sheet after settling their debts? So they have to pay mom 65 and Sophie 5 off the top. So they pay off 70 in liabilities. So no more liabilities, 0 liabilities. What are their assets? How much do they have left in the bank account? So they had 150, they paid 70, $80 left in the bank account. Now we know that the top half of the balance sheet, it's not actually a half, but the top of the balance sheet has to balance with the bottom of the balance sheet. So what's their equity? There's no liabilities. The assets are 80, what's their equity? That's right, their equity is 80. They have 80 in retained earnings. They have 80 in profit. That 80 is their collected value. Great job. So now you know how to read a balance sheet. You've probably been wondering your whole life what was going on with that balance sheet when it printed out of your QuickBooks. They often look really complicated, but all you have to do is look for assets on the top. And you know they need to balance with liabilities and equity on the bottom. This is a balance sheet for Coca-Cola at the end of 2024. So Coca-Cola has 100 billion in assets. It says 100 million there, but at the top corner, you'll see it says all numbers in thousands. So they have to add 3 more zeros. So it's 100 billion in assets, and they have 70 billion in liabilities and 25 billion in equity. That 75 and the 25 adds up to the 100. Interesting thing to note here, they have about 3 times as much liabilities as equity. So we say that our debt to equity is 3. Now, most bankers want them to be about equal. So when you look at what you owe and what you have on the bottom half of your sheet, you like those to be about the same or what you have to be more for a banker to want to give you money. For a small business that had a really good track record, they might go as high as 2 to 1. So 2 times the liabilities, twice as many liabilities, 2 times equity. But for most of us, they want us to be, 1 to 1 or even more equity than liabilities. A gigantic multinational corporation like Coca-Cola will be allowed to carry more debt because they have the cash to pay the interest. And so Coca-Cola is 3 to 1, but that would be a lot. All right, we know what the income statement is. It shows income and expenses over a set period of time. And we know what the balance sheet is. It shows what you owe and have at a particular moment of time. The last statement is the cash flow statement. The cash flow statement is the one you're least likely to use as a small business owner. It takes some information from the income statement and the balance sheet and reorders them. So you can tell if the company generated cash over that period of time. But for most small businesses, cash flow isn't too complicated. So when you buy things, you spend the money right then. And when you sell things, you get the money right then. So it's not hard to tell if you have cash. Just look, do I have cash? Statement of cash flows isn't terribly necessary for most small businesses because it's easy to tell what's going on. However, for a really complicated company like Coca-Cola, it can be difficult to tell if the company's generating cash. So this is the Coca-Cola statement of cash flows, and there's a whole lot going on. They have regular operating activities like making or selling drinks. And then they do some investing things like buying stocks and bonds and buying other companies. You imagine that adds up and gets pretty complicated. You can't tell what went in and what went out. And they also have financing activities, ways that they raise money, like issuing stocks or bonds or buying back their own stock from the stock market. So if you need to make a cash flow statement, for example, when you're applying for a loan, the best thing to do is get an accountant to make you one, so everything is correct. You may be able to get some free accounting help from a SCORE mentor or from a local agency like MSBDC. So we're not going to make a cash flow statement today because most small business owners really can't do that by themselves. But what we are going to do is we're going to do a quick tour so we understand why it matters. And, we have a little bit more information about why people have them. So a cash flow statement lists 3 kinds of cash activities, and they overlap with the income statement on the balance sheet. The first one is cash from operating activities. And these are all the normal things you're used to seeing from the income statement or the P&L. There's income, cash from customers. There's expenses, cash out to vendors. There's payroll, cash out to employees. Interest paid, taxes paid, inventory, so cash for materials, and working capital. Now, working capital is an important concept. It's basically money that belongs in your pocket but isn't there yet. So if somebody owes you but they haven't paid you yet, that's negative working capital. And if somebody pays you early, when has that ever happened? That's positive working capital. So that's why it's so important to collect from your customers right away. If you wait, you're basically letting them keep your money in their pocket. And that can actually cost you money over time. So working capital is cash from operating activities. And you want to make sure that when you have a chance to invoice, you invoice right away, and that you collect right away. And if they don't pay you, you call them and say, you really need to pay me right away. Okay, the second kind of cash is cash from investing activities. So this includes buying or selling pretty much anything, like selling part of a business or buying part of a business. It also includes lending money to someone else or another business. So if a company has a really big positive number in cash from investing, you know that they are collecting money and they're not spending it. They're being very careful. If you see a big negative number, you know they're investing a lot. So they're spending a lot of money. And the third kind of cash is cash from financing activities. So this includes payments to reduce debt or equity. So that's paying back a loan, buying back your company stock from the market if you're a public company, or paying dividends to your investors. If you see a really big positive number in cash from financing, it means that the company's raising money. They can do that by taking out new loans or issuing bonds or issuing stock, taking on more investors. And if you see a big negative number, it means that the company is paying off their loans or buying back their shares or giving out dividends. So don't worry. This slide is in the PDF takeaway, so you can have it for the future. This just gives you a sense of what matters on the cash flow statement. So a big positive number in the first category is good. It means that your company's making money from its operating activities. But the other 2 categories are complicated and they require interpretation. So, for example, you might think that a big negative number in investing is bad, but usually it means that the company's confident and they're doing really well. They're investing aggressively. So when the company's being careful with their money, you think that would be good, and sometimes it is. But sometimes it's a bad sign. It means that they're not confident enough to take chances. If the cash from financing activities is negative, that might be good because it might be that they're paying off their loans because they're doing really well. But it could also be bad. Maybe they don't have any good ideas for what to do with their money, so they're just giving it back to their investors. So investors need all 3 of the financial statements together when they're deciding to evaluate a company or when they're buying a stock, which is just buying a small piece of a company. If they have to understand what does their operation look like, that's the income statement. And then what's their financial position? What do they have and what do they owe? And then how much cash are they generating? Are they really generating cash? And so they need all 3 to make an evaluation and to answer the questions about, is it good or bad that they're investing a lot of money, right? Because it's hard to tell without looking at the whole picture. So that's why we have 3 financial statements instead of just 1. And there's always more to learn. If you want to read more about financial statements, I've included some links to further reading in the PDF takeaway. You can just click on them and go see some sites, and you can always look up other sites. All right, that brings us to best practice number 5. Know the 3 financial statements. And now you know how to read them. Pop quiz. What is true about the income statement? That's right, all of the above. And you can tell that Mavis wrote this question because Mavis likes to write questions where the answer is all of the above. Okay. Next question. What is true about the balance sheet? Correct answer is number 1, assets balanced with liabilities and equity. Which of the following is an example of an asset? Cash in the bank, and I want as much of that as I can get. Which of the following is a liability? A liability is something you owe to someone else. Credit card debt. Which of the following is an example of equity? This is a hard one. And the answer is retained earnings. If you don't sell stock, if you're not a public company, then equity is retained earnings or owner's equity. All right, last one for now. What are the 3 categories on the cash flow statement? And spoiler alert, it's not earth, wind, and fire. This is a trick question. Assets, liabilities, and equity are 3 categories, but they are the ones on the balance sheet. The cash flow statement has operating activities, investing activities, and financing activities. Good, good, good. Okay. Now that we've learned how to read financial statements, let's play finance detective. Let's start with our lemonade stand. Now, last year, Michaela and Sophie ran their lemonade stand for 1 day and they made $80. So here are their financial statements. All 3 financial statements together, very exciting. So what should we be looking for here? On the income statement, we want to see how much revenue and how much net income. So we've already been through this income statement. The gross margin is 67%. Is that good? It's pretty good for most product businesses. Manufacturing typically can have a gross margin of 23 to 35%. So, often manufacturing is much more expensive than this. So lemonade's pretty cheap from a cost of goods sold perspective. And consulting's even better. Consulting's often 80% or even better, depending on if you have to travel and so forth. Sometimes you can get your clients to pay for the travel. So look at that, look at those revenue, look at those expenses and see what's the gross margin. And then ask yourself, is that a good gross margin for your industry? And you can look that up on the internet. What's a good gross margin for my industry? Their net margin is 53%. That's great. If you have more than half of your revenue left after all your costs, that's excellent. So look at that income statement and say, what's their revenue? What's their gross margin? Is that good for their industry? What's their net margin? Is that good for their industry? Okay, look at the balance sheet. Now, cash, do they have enough? Now, the rule of thumb is you're supposed to have enough cash to run your business for 6 months. So 6 months of costs, so that you could survive in case of, for example, a pandemic. But most people don't really have that. Now, the lemonade stand has only 1 day of cash right now, so they need $50 to make a batch of lemonade, and they have $80. It's not unusual to not have enough cash, especially early in the business, but ideally, you would have 6 months of expenses in cash. It's a nice world if you can be in it. Okay, and then you look at accounts receivable. Are they collecting for their clients, or are they letting their clients keep their money in their pocket? The client's keeping the business owner's money in their pocket longer than they should. This lemonade stand doesn't have any accounts receivable because they collected their payment right away. And then you want to look at the bottom half of the balance sheet. Compare the debt to the equity. Ideally, they should be about equal, or equity should be higher. If the business is really successful, the bank might allow debt to be as high as 2 to 1. So how about these guys? What's their debt to their equity? They actually have 100% equity. I'm looking at the wrong sheet. There we go. Now look at the cash flow statement. I'm sorry, we didn't finish with their debt to equity. So they're 100% equity. So that's fine if they wanted to get a loan. On the cash flow statement, all we really want to look at is the bottom line. How much cash did they generate last year? So the lemonade stand created $80 in cash. So would you want to make a living selling lemonade? Jared, Rana, Mavis, Stacy, Monica, feel free to join in and tell us, would you, looking at these financial statements, Ismani, Julie, would you want to run a lemonade stand for your business?
If my goal is a $30 toy, then yes.
Mavis says if her goal is to get a $30 toy, then 1 day of lemonade stand would do the trick. Okay.
If my goal is to buy a yacht, no.
Oh, if your goal is to buy a yacht, it's going to take many, many years of lemonade stand. Is your goal to buy a yacht, Mavis?
I don't like both.
Oh, she doesn't like boats. She gets seasick. Okay, it's not to buy a yacht. All right, so your goal really matters. What kinds of shocks could happen to a lemonade stand? What could go wrong with a lemonade stand?
Bad weather.
Ooh, if it rains, nobody's gonna stop at the lemonade stand. They're just gonna drive by in their car. Right? What about competing lemonade stands?
Right, the little boys down the street might want to start a lemonade stand. They might get jealous.
Right. If they figure out that they're making $80 a day, they might just set up their own lemonade stand, right? So now we've got competition. What if they only made half as much revenue? How would they be doing? Their costs were $70 and they made $150. So if they made half as much revenue, they'd really be kind of just breaking even, right?
Right.
Yeah. So it's tough business, has some risks. But because they had the goal, they just wanted $30 toys. They met their goal. What about inflation?
Yeah, lemons, if lemons are gonna be imported from somewhere, then there could be some expensive lemons.
Right. What if there's a tariff on lemons? Right? What if we had some inflation or a tariff on lemons? Well, those are risks to this business, right? So things could go upside down pretty quickly with the lemonade business. But given the goals and given that they only did it for 1 day, they didn't have a lot of competition that day and the weather was good, that went pretty well. Let's take a look at the next one. So this is Tech Buddy Solutions. The owner is a technology consultant who solves technology problems for mid-sized companies. He borrowed $5,000 last year to start the business. He earned $80,000 in revenue and he had $22,600 in expenses. He paid off his $5,000 loan this year. So he took out a $5,000 loan last year and he paid it off this year. So what can we learn from his income statement? So we're going to do the same thing. We're going to look at that income. We're going to look at that gross margin. We're going to look at that net margin. So the income was 80,000. What was the gross margin? Gross margin percent is 98%. That's great. And that's often common in consulting firms. There may not be a lot of expenses for delivering with a consulting firm, depending on what kind of consulting you're doing. So 60 to 80% is a normal consulting gross margin. TechBuddy is doing 98%. So that's great. The net income is 72%. That's also terrific. So his biggest expense is rent. Do you think TechBuddy really needs office space?
Nope.
Maybe not. He could even be making more. Okay. What can we learn from the balance sheet? Does he have enough cash? Does he have 6 months worth of cash? So his expenses last year were 22,000 and he has 70,000 in cash. So he has way more than 6 months of cash. So that's good, right? Now, what about his accounts receivable? Is he collecting accounts receivable? He has a little accounts receivable. Maybe he could collect half up front, do something to reduce his accounts receivable. And then what about his debt to equity? Does he have more equity than debt? He does. He has a lot more equity than debt. Okay, so the financial position looks good. So the income statement looks good. The financial position looks good. What can we learn from the cash flow statement? He generated 46,400 in cash last year. So that's pretty good. So would you want to be running TechBuddy Consulting?
Yes, it looks good.
It looks good. Looks like a pretty good business, TechBuddy Consulting. I only have one question. He didn't spend very much on marketing. So how's he getting new clients?
Referrals.
From referrals from friends, right? Maybe from networking. So I'm a little bit worried about whether he's going to hit the wall when he runs out of his current network. So he's getting work from people he already knows, maybe people he used to work for. And I'm a little bit worried that he's going to run out of his network, that he's not actually marketing yet. We see that a lot with our clients. We have people who actually, I have a client who makes $400,000 a year, but is still working with somebody he used to work for. And so he has one really, really good client, but he needs to build up other clients so that he can have a little bit more diversity. And so that if something happens with that one client, he's in better shape, right? So I'd be worried a little bit about TechBuddy that maybe he needs to develop some marketing. He also spent a fair amount on equipment. I'm wondering if he might have unexpected equipment needs in the future. But he seems to be doing a really good job of keeping cash on hand and not getting in too much debt. So I'm feeling pretty good about TechBuddy. Last one. These are the financial statements for Glowberry Naturals. Now, the owner has created a series of all natural skin creams. She outsources the manufacturing to a factory that does small batches. What can we learn from this income statement? The gross margin is 60%. Is that good for a product? We said manufacturing could be 25 to 35% gross margin, so 60 is really good. Now the EBIT margin or net margin is 17%. So that's a lot tighter than our previous two examples, but there's nothing really wrong with it. Grocery stores have a 1 to 2% bottom line margin. Cars have a 3% bottom line margin. In my field, education services, you'd be very happy to have an 8% bottom line margin. So 17% isn't bad. So the biggest expense is marketing. She's spending $19,000, which is more than 25% of her revenue on marketing. Maybe there are better ways to market. And does she need to pay rent? Is she selling retail? Interesting. All right, let's look at her balance sheet. What can you learn from that balance sheet?
She's got a lot of loans.
Ooh, she has a lot of loans. She has $35,000 in loans. That's a lot. Does she have the same amount of debt and equity? Does she have more debt than equity?
She has more debt than equity.
More debt than equity. Right? So she probably couldn't get any more loans right now. She's probably got as much as she can get in loans. She paid $1,000 in interest expense last year. All right, so she has to learn to manage debt. Does she have enough inventory so that she, does she need more money to make more inventory? We have a client who had spent a lot of money on inventory, but the materials were going to expire in a certain amount of time. It was a supplement that, that mothers could take when they were lactating. And, they were gonna expire. So if your inventory expires, that's a risk. All right, what can we learn from the cash flow statement? She only generated 2,000 in cash last year. So that's not a very high number. So we'd like to see her generating more cash. So I might be a little worried about Glowberry Naturals. Might be worried that she couldn't get enough cash to run her business. She might need an investor if she's going to get enough to move that inventory. A little bit of a cash-starved business. If she had a little more cash, she might be able to grow faster. Okay. So how was that game? Do you feel like you know a little bit more about how to read financial statements than you did when you came in today? Thinking about it. We got a yes. We got a yes. How about you, Ismani? Let us know. We're always trying to improve our presentations. All right, so that brings us to best practice number 6. Keep increasing your financial knowledge. The more you learn, the better you're going to be at making decisions about your business. On that note, please don't forget to participate in part 2 of our business financial series for the City of Cambridge Community Development Department. It's in this same place at this same time, 2 weeks from now on Monday, March 10th, and it's called Are You Bankable? We're going to do a deep dive into how bankers think about business loans, and we're going to spend a special section on how to tell the best story about your business, and we're going to cover how to tell stories about things that might not be the best things in your business history. So we hope to see you there. And we have plenty of time to do some questions. But for our last best practice, what should you do when you really need help with your business financials? Best practice number 7, seek help from experts when you need it. When it's time to clean up your books, make sure that you at least check your work with an accountant. When you need to make new contracts, spend just a little bit of money with a lawyer to make sure the contracts are correct. You may qualify for free legal aid at an office in your community, and find business mentors. There's some fantastic business mentor organizations like SCORE, the Center for Women in Enterprise, SBDC, Mass Development, Verizon, and you can come here and talk with Jared and the CDD about things to help you with your business. So take advantage of the fantastic things that are in your community. Endorsement from Monica, thank you. All right, so we have done it. We have 7 fantastic best practices. Number 1, don't wait until you need the money. It's always easiest to get the money when you don't need it. Number 2, know your audience. Look at the stakeholders, read everything you can about them, learn about them before you chat with them. Number 3, make a monthly appointment with yourself. And as you get better and better at the things you're doing in that appointment, add more advanced things into it. Number 4, learn some business vocabulary, and you can keep these notes. I think they'll be very helpful to you. Number 5, know the 3 financial statements. Number 6, keep increasing your financial knowledge. And number 7, seek help from experts when you need it. Take advantage of free resources. There are lots of great free resources. If you don't know what the free resources are, you can always link up with me on LinkedIn. I'm happy to help whenever I can. All right, what did you think of our webinar? That's our last pop quiz. Let us know. Send us a note on LinkedIn if you liked it. And this, as promised, is the QR code so that you can get the PDF takeaway. So you can use your phone. I think Stacy is also going to go ahead. Oh, I got a thumbs up. Love those thumbs ups. Little animated thumbs up. You can use your phone to get this QR code to get the link so that you can get the PDF takeaway. If for some reason it doesn't work, you can't get it, just link with me on LinkedIn. I'm the only Karen Baldwin, I promise. And Stacy's also going to stick that code into the chat in case the link is a little bit easier for you to use. There it is, Business Financials Takeaway and my LinkedIn as promised. Thank you very much, Ms. Stacy. Grab that takeaway and hopefully those notes are really useful to you. And now it is Q&A time and you can ask us anything. How much fun is that? Hopefully you've got the code by now. And the link is still in the chat if you didn't have it yet. All right, so I'm gonna look in that Q&A. I didn't see any questions pop up in there, but.
And there was one question about whether or not, Julie needs to save all the receipts for all of her expenses.
Well, different fields are different. And so, you know, the first concern is the IRS. And so you want to make sure that you're keeping the receipts that are important to the IRS. And I haven't done this in a little while, so I'm not recalling what the kind of minimum number is that they say that you need to have a receipt for, but definitely go to the IRS and ask what's the minimum that I need to have a receipt as proof. I keep everything down to the penny, but I'm also, you know, a little bit compulsive. And so if there's not a rule that says you have to do it, you know, I think that that you can be happy with whatever the IRS's minimum is. I like to know. I'm just curious that way. Does that answer the question? Hopefully. Okay. Other questions? You can ask us in the chat. You can raise your hand. Whatever works. All right, Karen, can you clarify how to classify a home office? Is it a direct or a fixed? Home office is usually a fixed cost. So you have to pay the expenses for your home office, whether or not you sell anything. But you can tell that accounting is really much more of an art than a science. And you'll see in different companies, the same thing being treated differently. You'll see in different industries, the same thing being treated differently. And so it's not, accounting is not a hard and fast set of rules, except in some very small cases. But typically, if the money isn't going directly into making the thing that's being sold and it doesn't go up when you sell more, you know, one more thing, one more cost, one more thing, one more cost, then it's probably a fixed cost. Most costs are fixed costs. So if it's not a direct material or labor that goes into making the cost, what about my computer and my cell phone? I would typically call those fixed costs, right? Because you don't have to buy another computer if you sell one more piece of jewelry, or you don't have to buy another computer if you sell one more consulting engagement, right? Great questions. Any other questions? Do I have to show a banker all these documents to get a loan? We are going to have a good time in the next webinar talking about documents. And it's kind of a game that we have to play with the banker to get them all the documents. Like one of our clients just got a loan, actually for a restaurant. And I would say I got 3 really exasperated messages from her. Why do they need this one more thing? But that's the way it is. You have to just send in the one more thing. And she did eventually get the loan. So yes, you do have to show the banker all of the documents to get the loan, but in the end, it's worth it. And one of the things that's great about getting a bank loan is that you get to keep all of your equity. So if you can get the loan, which is the hard part, then, you know, as long as you're successful with your business, you get to keep all the equity. So it's a nice way to grow your business without giving part of it up. Other questions? All right. Do I need fancy software to track my income and expenses? You don't. You don't. And I tracked mine on a paper ledger for years. I ran a consulting business and I ran a tutoring business and I had my POS. I had like a credit card machine for taking the payments from the parents for the students. And so that kept track of my revenue. And I could just, my monthly appointment with myself, I could just write that down. And then I could track my costs on a little paper ledger and did that just fine. For 6 years running a tutoring business. So you don't need fancy software to do that. The simple versions of the software can be free and it's good to learn how it works. And so if you have the enthusiasm to try one of those softwares, it's worth your time to, to make some mistakes and learn how it works. And you'll learn a lot just by trying to enter things into the software. So it's worth your time to experiment with it, but you don't need it. And if you're doing really well with your business without it, then there's no need to incur that expense. Right?
Yeah.
Any other questions? All right, if you have further questions, it seemed like, was maybe pretty self-explanatory today, but do link with us on LinkedIn and ask, or, when you go to get your PDF, you'll see a green button that says, make an appointment with Mavis, and you can make a free appointment with Mavis to talk about your business. I promise she won't try to sell you consulting or anything else. She'll just talk with you about your business for 15 minutes. So if you want to have a Zenagos expert talk with you about your business, feel free to make an appointment with Mavis and she'll do that. Or you can link with me on LinkedIn, ask me any question you want. We'd be really happy to chat with you. Thank you so much for spending some of your valuable time today. We know that your time is precious and we really appreciate it. And Jared, you had some things that you wanted to say at the end.
Yeah. So again, thank you everyone who joined. We do have one more follow-up workshop, Are You Bankable, on March 10th, 6 to 8 p.m. Again, it's hybrid, so either here, second floor of the City Hall Annex, or on Zoom. And Zoom details will be sent out a few days before the workshop. In addition, I'm going to drop a link into the chat in case anybody is interested in one-on-one coaching and is eligible. And if you have any questions regarding that piece, I will also give you my email. And with that, I wish you all a wonderful evening.
Thanks, everyone.
Thanks, everybody.
Bye.